Welcome back to the Deep Dive. If you've been following along, you'll know we've spent some time with Harrison's Holdings, HHMB. We've looked at their share split, dug into their Q3 2024 results. Today, we're building on that. We'll look at Q4 and the full year 2024. But crucially, we're jumping right into their latest numbers, the 2Q 2025 and the year-to-date picture up to June. Basically, how are they doing now? What are the big challenges? And, what's next?
Exactly. And having that background from our previous dives is really helpful. It gives us the context to really understand what these new figures mean. So whether you're tracking HHMB closely, watching the whole Malaysian FMCG scene, or just interested in how companies handle these kinds of, tough times, this should give you some key takeaways.
Okay. Sounds good. Let's unpack this then. Let's kick off with the full year 2024 for Harrison's. Revenue dipped, right? About 3.7% down.
That's right. Around RM 83 million less than 2023. And the main culprit, as you said, was their fast-moving consumer products division, the FMCG side.
And that hit profitability even harder.
Oh, definitely. Profit before tax, PBT, that fell nearly 33%, a big drop, almost RM 30 million. And profit after tax, PET, and the profit for shareholders, both down over 36%. If you adjust for that 5-for-1 share split we talked about before, the earnings per share for 2024 ended up at 12.58 sen. That's quite a bit lower than the 19.68 sen in 2023.
So what drove such a significant decline? It wasn't just one thing, was it?
No, not at all. It feels like they got hit from multiple angles. You had weaker consumer sentiment in Malaysia generally, people being more cautious. Then there's increased pressure from parallel imports, those cheaper unofficial imports, plus new competitors popping up, especially in East Malaysia, which is really a key area for HHMB. Add to that shrinking gross profit margins, higher admin costs, including setting money aside for doubtful debts, meaning they're worried about getting paid, and even higher interest costs because they borrowed more. It's a lot of pressure points converging.
Oh, yeah, that really does paint a picture of a challenging year. Okay, let's zoom in on Q4 2024 specifically. How did the last quarter shape up compared to Q4 2023?
Well, the trend pretty much continued. Revenue in Q4 was down 5.4% year-on-year. Again, mostly lower FMCG sales. And PBT, that took a really sharp dive, down over 45% compared to Q4 the previous year.
45%, that's steep.
It is. Now, they did mention Q4 can be seasonally weaker than Q3, but this was still significant. Lower sales, lower gross profit margin, partly because they sold more lower margin stuff. And importantly, Q4 2023 had a one-off goose. They reversed an old stock provision. That didn't happen in Q4 2024, so the comparison looks worse. Admin costs were actually a bit lower in Q4 24 due to some reversals, but higher interest costs still weighed things down.
Right. So 2024, clearly tough. But what everyone wants to know is, how are things now? Let's jump to the first half of 2025. What do these latest Q2 and year-to-date June results tell us?
Okay, so Q2 2025 versus Q2 2024, revenue was basically flat, down just 0.09%, tiny change. But profitability, that's where you see the continued pressure. PBT dropped almost 18%, PT down about 17%, and EPS fell from 3.47 sen down to 2.90 sen for the quarter.
And what's behind that decline in Q2?
A few things again. Gross profit margin slipped a bit from 11.75% to 11.51%. They said it was mainly due to lower supplier incentives. Admin expenses jumped by about RM 1.5 million. A big factor there was the minimum wage increase kicking in from February 2025. And they also made a provision for doubtful debts of just over 1 million ringgit. That's a swing from the previous year where they actually reversed a provision. So that hurts the comparison. Oh, and they also booked a small loss, about RM 264,000, on some financial assets, like unit trust, because the local stock market dipped.
Okay, that covers Q2. What about the year-to-date picture, the first 6 months of 2025 compared to 2024?
Right, YTD June 2025 versus YTD June 2024. Revenue actually edged up slightly, 0.25%, driven by FMCG sales, interestingly. But despite that tiny revenue uptick, PBT for the first half of 2025 was still lower by about RM 4.7 million, or nearly 13%.
The reasons sound familiar.
Pretty much. Higher admin expenses, up RM 3.7 million. Again, minimum wages. Plus, an increased provision for doubtful debts. They specifically mentioned Sabah here, saying trade receivable collection has been slower there. And that provision for fair value loss on financial assets also increased for the half year, hitting RM 328,000.
Okay, so consistent themes of rising costs and collection issues hitting the bottom line, even if revenue is stabilizing somewhat. But HHMB isn't just one big entity, right? They have different business segments. How does those individual parts perform? Let's look at FY 2024 first, then the YTD June 2025 picture.
Absolutely. Breaking it down helps. Their main division, trading and distribution, which is like over 97% of their revenue. For the full year 2024, its overall revenue fell about 3.7%. Within that, FMCG sales dropped almost 6%, which really dragged things down. But there were some bright spots. Building materials actually grew 3.5%, maybe dealers stocking up ahead of price hikes, perhaps. And industrial and agriculture chemicals jumped over 16%, quite strong. But despite those pockets of growth, the segment's overall profit before interest and tax, PBIT, was down significantly over 29% for FY 2024.
Okay, so even the growth areas couldn't offset the FMCG decline in profit terms for 2024. How about the first half of 2025 for trading and distribution?
For YTD June 2025, revenue for the segment actually ticked up slightly, 0.27%, and FMCG sales up 2.49%. That's a turnaround from the declines we saw before.
Oh, that's interesting, a positive sign.
Potentially. But building materials and engineering products went the other way, down about 10.5%. They cited sluggish business and slower construction. Industrial and agrochemicals continued strong, though, up nearly 17%, driven by demand in Sabah again. But here's the kicker. Despite the slight revenue increase and the FMCG bump, PBIT for this whole segment still decreased by 5.47% year-to-date.
And the reasons are?
Same story mostly. Minimum wage increases, higher provisions for doubtful debts, and overall lower margins squeezing the profit.
Okay, so even where revenue is growing, costs are growing faster or margins are shrinking. What about the retailing segment? Famous Amos in Singapore.
Right, retailing. In FY 2024, revenue there decreased by about 6.6%, mainly because they stopped distributing the Kanoya brand. Profitability took a hit too. Lower gross margins because cookie batter got more expensive, and higher salary costs in Singapore due to new minimum wage rules there.
And for the first half of 2025?
For YTD June 2025, retailing revenue actually increased slightly, 2.36%, thanks to higher Famous Amos sales. However, the segment actually recorded a loss before interest and tax of RM 30,000. That's compared to a profit in the same period last year.
A loss, even with higher sales.
Yeah. Driven by those same factors. Lower gross profit margin because of the batter price and increased salary costs in Singapore. It just couldn't overcome those pressures.
Okay. And the last bit, the smaller shipping and other segment. Any better news there?
Well, in FY 2024, it actually looked pretty resilient. Revenue was up over 10%, and PBIT grew over 11%. That was thanks to higher shipping commissions, especially in Sabah, and some sundry revenue right back. It was a nice contract.
But did that continue into 2025?
Unfortunately, no. For YTD June 2025, this segment saw revenue decrease by nearly 7% due to lower shipping agency fees in Sabah, and its PBIT. That fell sharply, down almost 58.5%. It was also impacted by a higher provision for losses on their financial assets.
Right, so even the smaller bright spot from 2024 dimmed in the first half of this year. Okay, we've covered the numbers, the segments. Let's talk overall financial health. What do the key ratios tell us? And how strong is their defense against competition, their economic moat?
Okay, let's look at profitability ratios. Things like gross profit margin, PBT margin, PATMI margin, return on equity. They all show a consistent decline across FY 2024 and then into Q1 and Q2 2025. Just as an example, that Q2 2025 gross profit margin was 11.51%, down from 11.75% year earlier. The PBT margin fell from 3.02% to 2.48%. It clearly shows, severe pressure on their ability to actually make money from their sales and assets. It's getting tougher.
And efficiency, how well are they managing costs?
Well, if you look at the administrative expense to revenue ratio, that's gone up, especially in the first half of 2025. Primarily, it's those minimum wage increases from February and that significant jump in provisions for doubtful debts, particularly in Sabah, where collection seems slower.
What about debt, leverage?
Their leverage ratios. The debt-to-equity ratio is still manageable. It bounces around a bit, but stays below 0.5x. And their borrowing structure hasn't really changed much, still mainly bankers' acceptances. However, the interest coverage ratio, that's a key one. It measures how easily operating profit covers interest payments. That's declined significantly. It went from 8.72 times in YTD June 2024 down to 7.27 times in YTD June 2025.
And that's a warning sign.
It's definitely a flag. It means their operating profit cushion for covering interest payments is shrinking. Partly because average interest rates ticked up slightly from 3.72% to 3.82% on those bankers' acceptances, but mainly because their PBIT itself is decreasing.
Okay. Any bright spots in the ratios?
Yes, liquidity ratios, like the current ratio, that measures their ability to meet short-term obligations. It's remained stable and actually quite healthy, around 1.98 times in Q2 2025. So despite the operational and profit challenges, they seem okay in terms of short-term cash flow management.
And shareholder ratios. We already touched on EPS.
Right. As we discussed, earnings per share has just consistently declined across all the periods we've looked at. FY 2024 versus 23, Q1 25 versus Q1 24, Q2 25 versus Q2 24. It reflects that pressure on the bottom line.
So pulling that together, what about their economic moat? How protected are they? You rated it before.
Yeah, based on this performance and what they're saying about the market pressures, their economic moat looks, well, relatively weak. If I had to score it, maybe a 4 out of 10.
Only a 4. Why so low?
It's pretty clear from their own reports. Intense competition, especially from parallel imports and those new players in East Malaysia, is actively eating into their sales, their profits, their margins, particularly in that core FMCG area. Their established distribution networks are valuable, sure, but right now they just aren't providing enough protection against these competitive forces.
Understood. Now, the reports don't give an overall 110 financial scorecard, you said, but based on everything, the ratios, the moat, the trends, how would you summarize their current financial standing for our listeners? Are they on shaky ground?
It's definitely a mixed picture, leaning towards caution. On the plus side, their liquidity is stable, they can pay their immediate bills, which is good, but profitability is under severe and consistent pressure. Competition, rising costs, higher interest. It's hitting them hard. So while they're not facing like imminent cash crunch, the path back to strong, consistent profits looks quite challenging with these headwinds blowing.
Okay, that makes sense. Given that challenging profitability picture, what about dividends? Are those payouts at risk? And how is management actually planning to navigate this? What's their strategic direction for the next, say, 5 years?
Yeah, the dividend question is key. And yes, the payout is definitely under pressure and carries a degree of risk. That's directly tied to the falling profitability and EPS we've been talking about. They declared a final dividend of 6.5 cents per share for FY 2024, which gets paid out in August 2025. That's down from the adjusted 10 cents per share for FY 2023.
So a cut reflecting the lower earnings.
Exactly. It's a direct reflection. Now, if you look at the payout ratios, the cash they paid out in 2024, which was based on 2023's earnings, was actually quite high, around 79.5% of profit. But the payout based on the declared FY 2024 dividend and the earnings for that year is lower by 51.6%.
So they're adjusting the payout to the reality of lower profits.
Precisely. It shows they're still committed to shareholders, wanting to return cash, but they're also being pragmatic. They're not trying to maintain a payout level that the current earnings don't support.
Okay, and what about management strategy? What are they saying they'll do about these headwinds?
They're very upfront about the challenges. They acknowledge the subdued consumer sentiment, the parallel imports, the tough competition in East Malaysia impacting FMCG, no hiding from it. Their stated plans focus on working closely with their main suppliers to fight back on the competitive front, trying to stabilize and hopefully improve those gross profit margins, and being really diligent about managing admin expenses. That includes tackling those doubtful debts, especially in Sabah, and dealing with the higher interest costs.
Are there any concrete actions beyond those general plans?
Yes, there's one very significant tangible investment. They're building a major new warehouse and logistics facility in Kota Kinabalu, Sabah. It's a RM 28 million project.
28 million, that's serious.
It is. Construction started in February 2025, and they expect it to be finished by April 2026. This really signals a clear focus on strengthening their infrastructure and market position in East Malaysia. It's a long-term play in a key region. Overall, management expresses a cautiously optimistic view for 2025. They hope business growth will track Malaysia's overall economic forecast, which is somewhere between 4.1% and 5.5% GDP growth. They believe the group's long-term growth potential is still intact, assuming no major new shocks hit the system.
Right, cautious optimism backed by a big infrastructure bet in Sabah. Okay, so bringing it all together, if things are going to turn around, what are the key catalysts? What are the top, say, 5 things that could really drive HHB's performance over the next couple of years?
Okay, top 5 catalysts to watch. First, definitely the completion and, more importantly, the operational impact of that new Kota Kinabalu warehouse. That RM 28 million isn't just sunk cost. The goal is better logistics, lower operating costs, and a stronger competitive edge in East Malaysia. Will it actually deliver those sales and profit boosts? That's catalyst number 1.
Makes sense. What's second?
Second, a broader recovery in Malaysian consumer sentiment and the economy. If consumers start feeling more confident and spending more freely, that would directly help counter the subdued sentiment hurting FMCG sales. If Malaysia hits that projected 4 or 5% GDP growth, HHB should benefit.
Okay, an external factor helping them out. Third.
Third is internal. Successful stabilization and ideally improvement of their gross profit margins. Can they manage costs better? Can they shift the product mix? Can they negotiate better with suppliers? Any success here flows straight to the bottom line. That shrinking margin trend needs to reverse.
Right. Margin improvement is critical.
Yeah.
Fourth goes back to competition. Effective collaboration with suppliers and real countermeasures against parallel imports and new entrants, especially in East Malaysia. It's not enough to just talk about it. We need to see evidence that their strategies are actually defending market share and maybe even improving pricing power.
Concrete results against the competition. And number 5.
Fifth is improved management of those administrative expenses and doubtful debts, effectively controlling costs like wages, and crucially, getting better at collecting receivables, particularly in Sabah. That improves the bottom line directly and also frees up working capital.
Got it. Warehouse impact, consumer recovery, margin stabilization, competitive countermoves, and better cost debt management. Those seem like the key battlegrounds.
Well, this has been a really thorough deep dive. We've seen Harrison's holdings facing some serious and consistent profit pressures, especially in their core FMCG business, declining margins, falling EPS. But on the other hand, their liquidity looks okay, and they are making that significant strategic investment in Sabah. Exactly. It's a company navigating some pretty strong headwinds right now, but they are showing commitment to shareholders via dividends, even if reduced. And they're making that long-term infrastructure play. They're not just standing still.
So for you, our listener, what's the key takeaway? Given these ongoing challenges, the strategic moves like the warehouse and the current financial state, what specific things should you be watching most closely? What tells you if HHMB is really turning the corner?
Yeah, good question. I'd say watch the actual impact of that Kota Kinabalu warehouse once it's up and running. Does it translate into better regional sales, lower costs? Keep a very close eye on those gross profit margins. Do they actually stabilize or start to tick up? Look for concrete signs, not just talk that they're successfully pushing back against parallel imports and new competitors in East Malaysia. Are sales trends improving there? Are margins holding up better? And definitely monitor those admin expenses and doubtful debt provisions. Are those numbers improving quarter by quarter? Success or failure on those fronts will really show whether their strategies are working and if that profitability trend can finally reverse.
Excellent points. Real operational metrics and competitive outcomes. That's what will tell the story. We definitely encourage you to keep looking at HHMB's future reports and keep an eye on that wider Malaysian economic context as these potential catalysts play out. Thanks for joining us on the Deep Dive.